Hey guys, welcome back to the channel. Jarrett White here with White Ridge Mortgage, and today we're going to be talking about buying your second property. Now, we're not just going to talk about the mortgage aspect, we're also going to talk about why it's actually a good idea to buy an investment property, and then also how you can manage it, because we all know, or we all have heard, being a landlord can be an absolute pain. So stay tuned. We're going to cover everything from mortgages to managing it. And if you wouldn't mind, please hit that like button, subscribe to the channel, and ring the bell to be notified when other videos just like this come out. It would mean a lot. Okay, so to start off with the mortgage aspect of things, people don't understand that not every bank is the same. And I'm even comparing major bank to major bank. One major bank in Canada, TD, Scotia, BMO, RBC, are all considered major banks, might treat that rental income completely different than another bank. You see, banks have policies where they either allow you to add rental income or the potential rental income that you're going to be making to your income to help you qualify, and other banks actually allow you to offset that income altogether. Now let's break down what that actually means. So if you have a rental add back policy, or your bank has one of those policies, what that's going to mean is if you're making $2,000 a month, you might be able to add, say, 50% of that $2,000 to your income. So in a year's time, that's really only adding about $12,000 annually. And with the rule of 4 saying that you roughly qualify for 4 to 5 times your income, $12,000 is only giving you about $60,000 to maybe $80,000 extra of borrowing power, which doesn't really amount to much. Now, there's other major banks that have offset policies, and this is very crucial for buying investment properties, and this is how you're going to end up making it work. You see, what an offset policy is they take a percentage of that rental income you're going to be making. So in this example, we'll use $2,000 again, and we'll use 50%. So the bank that's willing to offset it 50%, they're taking $1,000 from that $2,000 of rental income, and they're matching it up to the mortgage payment. So say the mortgage payment was $1,500. Well, they're taking that $1,000 and they're deducting that off the mortgage payment, and you're only having to qualify for the remaining amount. So in that case, you would only be qualifying for a $500 payment. That is much easier and much more realistic than simply just adding $12,000 or 50% of that rental income to your income. This can literally mean the difference of hundreds of thousands of dollars in borrowing power. That is why it's so important to work with a mortgage broker, but not just any mortgage broker, one that actually deals with a lot of rental purchases and knows the bank's policies. At White Ridge Mortgage, we help tons of investors with their second, third, fourth properties, and we'd be more than happy to help you too. Now, aside from just the rental add back versus rental offset, another thing that's gonna really help you get that borrowing power up for the mortgage is actually having your current mortgage structured properly. I see so many people that have such a low balance on their mortgage, $100,000, $200,000, $250,000, yet they're still making an outrageous monthly payment. And this is because they've been following their amortization schedule, and they only have, say, 10, 15 years left, but they're still paying at that 10, 15-year amortization rate. Now, what you can actually do is you can stretch out your mortgage to 30 years at every single time you renew. You can refinance it, stretch it out to 30 years, and what that's doing is it's making your minimum monthly payment quite a bit lower. Now, when we go to debt service you, which means the debts that we have to include when we're doing your qualification, we only have to include your minimum payments. We include your minimum payments on your mortgage. We include your minimum payments on your credit cards, line of credits. In some cases, banks make us use about 3% of the credit cards and line of credits. But when it comes to a fixed payment, mortgages, we use the minimum payment, not what you're actually paying. So if you were to stretch your mortgage out over 30 years, you're gonna have a much lower minimum payment and therefore qualify for a lot more. Now you may be thinking, well, why would I wanna do that? Now I'm paying my principal residence mortgage over 30 years. That's not true. What you can still do is use your prepayment privileges that the bank offers you, where you can double up your payment or use lump sums to literally pay it down in the exact amount of time than you would have if you just continued on your amortization. However, now you have a lower minimum monthly payment, which means if you're ever in a stressful situation, you could obviously lower your payment back down, which is one benefit. And the second benefit is that you're going to be able to qualify for quite a bit more when it comes to buying investment property. So those are the two major things you're going to want to look out for when you're getting a mortgage for an investment property. But why would you actually want to buy an investment property to begin with? Now, I'm sure you've all heard of the term leverage, and essentially what that is you're investing in an asset, but you're actually not investing all of your own money. You're investing the bank's money too, whereas you're the one that actually gets the return for the total asset value. So as an example, if you're buying a $500,000 home and you're putting $20,000 down, for an example, if you're buying a $500,000 home and you're putting 20% down, which is $100,000, you're still gonna get the benefit. If that property was to increase, say 3%, well, you're not getting 3% on your investment, which was the $100,000. You're getting 3% on the whole $500,000. So you're leveraging your money 5 times in that situation. Now, principal residences, where you can literally put as little as 5% down, you can leverage your money as much as 20 times, which is crazy. You could put $25,000 into a $500,000 home, and if that goes up 10% and is now worth $550,000, well, you've actually made 100% of your initial investment. Then that would mean you've already made 200% of your initial investment, yet the property actually only went up 10%. So leverage is extremely important when it comes to investing, and real estate is one of the best vehicles for that. Now, people usually take advantage of that with their principal residence. It's an actual stat that homeowners typically retire a lot wealthier than those who have rented their entire life. And I can obviously see why, where we live in Canada, BC, Ontario, even Alberta nowadays, it is getting crazy, the cost of living. Rent only goes up, your mortgage payment only ever goes down. So rent might be a better shorter term option, but definitely not in the long run. Now, why would you just do that with one property when you could do it with multiple? And in most cases, you can actually use your equity from your first property to help you buy the second property, and therefore you're not even spending any money out of your pocket. It's all just the bank's money, but you're getting the full return of the appreciation. So I'm a firm believer in buying investment properties. I think it's a great idea. But one thing that I do know for a fact is being a landlord is an absolute pain. And for a lot of people, this is what stops people from buying an investment property to begin with. It's because they don't want to manage it. They don't want to have a terrible tenant. And with BC, where I'm from, the laws have only gotten stricter for getting rid of them. You do not have much power as a landlord. The tenants actually have a lot of power here in BC. Alberta, it's more the other way around, but BC is similar to Ontario as well, where tenants have a lot of power. They have a lot of rights. So a lot of people don't want to deal with that. They don't want to deal with the headache. But you're missing out on so much opportunity by totally disregarding the whole idea of getting an investment property. And what you don't understand is there's some very good professional property management services out there that are very affordable. Most often, property managers will charge, say, 10-15% of your rent that you're charging the tenant, but they take care of everything. They help you find the tenant to begin with, and then they are that tenant's contact. If the washer breaks, they're the one that's coming. If there's any issues whatsoever, they are the person that the tenant is contacting. The tenant does not even know you exist. And this takes a whole lot of stress off your back, and you want to make sure that you're using a very reputable property management service because they do a very good job screening their tenants. In fact, most of them actually have just as strict rules as what banks would for lending someone a mortgage. They actually debt service their income, they look into their past employment history, they look at their credit reports. They can look at a lot to determine if someone is a good tenant for your property, because at the end of the day, if they were to put a bad tenant in that property, it just makes more work for them. So there you have it. That's kind of my scoop on how to buy your second property, the mortgage aspect, why you should consider buying one. And then if you actually did buy one, you do not have to manage it. You can hire a property manager. If you want more info or you want to just discuss it and see if it's right for you, click the link in the description. It'll take you to a contact form where you can book a call with me one-on-one. We can have a chat. We can see if this is right for you. Or I can answer any other questions you have. If there's anything mortgage related other than this that you want to discuss, we can talk about that too. Thanks for watching, guys. Catch you on the next one.